Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today we're covering two of the most powerful concepts in personal finance, the Roth IRA and compound interest. If you understand these two things and act on them, you will be in a fundamentally different financial position 10, 20, and 30 years from now than the average person. We're going to break both of them down completely today. What they are, how they work, and exactly how to take advantage of them. Quick note before we get into it. Everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Everyone's financial situation is different, so always do your own research or speak with a qualified financial professional before making investment decisions. Let's get into it. Let's start with compound interest because everything else builds on top of it. Most people have heard the phrase compound interest. Very few people truly understand how powerful it is, and almost nobody starts taking advantage of it as early as they should. Here is the simplest way to understand compound interest. With simple interest, you earn interest only on the money you put in. If you invest $1,000 and earn 10% per year, you make $100 every year. That's it. Flat. With compound interest, you earn interest on your money and on the interest you've already earned. That $100 you made in year one gets added to your $1,000. Now in year two, you're earning 10% on $1,100, not just $1,000. That gives you $110 instead of $100. The following year, you're earning on $1,210, then $1,331, then $1,464. It doesn't sound dramatic at first, but here's where it gets extraordinary. That same $1,000 invested at 10% per year, left completely untouched, becomes over $17,000 in 30 years. You put in $1,000 and time turned it into $17,000. You didn't do any additional work. You didn't add any more money. You just let compound interest do what it does. Now imagine that instead of $1,000, you invested $300 every single month. At the same 10% annual return over 30 years, that becomes over $650,000. You contributed $188,000 of your own money. The rest, over $500,000, came entirely from compound interest. That is not a typo. That is the mathematical reality of compound interest over time. Now here is the most important thing to understand about compound interest. Time is the single most valuable ingredient. Not the amount you invest, not the return rate. Time. The earlier you start, the more time compound interest has to work. Every year you wait is not just 1 year of growth you miss. It is 1 year of compounding on top of compounding on top of compounding that you can never get back. A 25-year-old who invests $200 a month will have significantly more money at 65 than a 35-year-old who invests $400 a month. Even though the 35-year-old is putting in twice as much money every month. The 25-year-old simply had more time. This is why financial experts say the best time to start investing was yesterday. The second best time is today. Now let's talk about the Roth IRA and why it is one of the most powerful tools available for building wealth over time. IRA stands for Individual Retirement Account. It's a special type of account that comes with significant tax advantages designed to encourage people to save for retirement. A Roth IRA specifically works like this. You contribute money that has already been taxed, meaning after-tax dollars from your paycheck. That money then grows completely tax-free inside the account. And when you withdraw it in retirement, you pay zero taxes on it. Not on the contributions, not on the growth, not on any of it. Let that sink in for a moment. Everything that compound interest builds inside your Roth IRA, all of that growth, is completely tax-free when you take it out in retirement. Compare that to a traditional 401k or IRA, where you contribute pre-tax dollars, the money grows tax-deferred, and then you pay income tax on every dollar you withdraw in retirement. With a Roth IRA, that tax bill doesn't exist. Here are the key rules you need to know about Roth IRAs. The contribution limit for 2026 is $7,000 per year if you're under 50. If you're 50 or older, you can contribute up to $8,000 per year under what's called the catch-up contribution rule. There are income limits to be aware of. To contribute the full amount to a Roth IRA as a single filer, your income needs to be below a certain threshold. And this changes slightly each year, so always confirm the current limits. If your income is above the limit, your contribution amount phases out, and above a higher threshold, you're no longer eligible to contribute directly. Contributions can be withdrawn at any time with no penalty. This is one of the most misunderstood features of the Roth IRA. Your contributions, not the earnings but the money you put in, can be taken out anytime without taxes or penalties. The earnings have more restrictions, but the principal is always accessible. The money inside your Roth IRA can be invested in stocks, index funds, ETFs, bonds, and more. Simply opening the account is not enough. You have to actually invest the money inside it. Many people open a Roth IRA, deposit money, and leave it sitting in cash without realizing the money isn't automatically invested. Now let's put compound interest and the Roth IRA together, because this is where it gets really powerful. If you contribute $500 a month to a Roth IRA starting at age 25, invested in a diversified index fund that averages 8% annual returns, here is what happens by age 65. You will have contributed $240,000 of your own money over 40 years. But thanks to compound interest, your account will have grown to approximately $1.7 million. And here is the extraordinary part, because it's in a Roth IRA. Every single dollar of that $1.7 million is completely tax-free when you withdraw it in retirement. The government has no claim on any of that growth. That is the combination of compound interest and the Roth IRA working together. Two of the most powerful forces in personal finance, time and tax-free growth, working in your favor simultaneously. So how do you actually get started? Step 1. Open a Roth IRA account. You can open one at any major brokerage. Fidelity, Vanguard, and Charles Schwab are three of the most trusted and beginner-friendly options. The process takes about 15 minutes online and is completely free to set up. Step 2. Fund your account. You can start with as little as a few dollars on most platforms. You don't need to max out the contribution limit right away. Start with whatever you can consistently afford. Even $50 a month is a start. The habit matters more than the amount in the beginning. Step 3. Invest your contributions. Once your money is in the account, you need to actually invest it. For most beginners, a simple index fund that tracks the total stock market or the S&P 500 is a solid starting point. These funds are diversified, low cost, and have historically delivered consistent long-term returns. Step 4. Automate your contributions. Set up automatic monthly transfers so the money moves from your bank account to your Roth IRA without you having to think about it. Automation removes the temptation to spend the money and ensures you're consistently building wealth every single month. Step 5. Leave it alone. This is the hardest part for most people. The entire power of compound interest depends on time and consistency. Check your account occasionally, rebalance if needed, but resist the urge to react to short-term market swings. The people who build wealth through investing are the ones who stay the course through good markets and bad ones. Let's also quickly address one of the most common questions about the Roth IRA. Should I choose a Roth IRA or a traditional IRA? The general rule of thumb is this. If you expect to be in a higher tax bracket in retirement than you are now, which is common for younger people who are earlier in their careers, the Roth IRA is typically the better choice because you pay taxes now at a lower rate and enjoy tax-free growth and withdrawals later. If you expect to be in a lower tax bracket in retirement, a traditional IRA or 401k might make more sense because you get the tax deduction now when your rate is higher. Many financial planners recommend having both types of accounts if possible, some pre-tax retirement savings and some Roth savings, to give yourself flexibility in retirement. To recap what we covered today, compound interest is the process of earning returns on both your principal and your accumulated growth. The earlier you start, the more dramatic the results. Time is the most valuable ingredient. A Roth IRA is a retirement account that lets your money grow completely tax-free. Contributions are made with after-tax dollars, and qualified withdrawals in retirement are completely tax-free, including all of the growth that compound interest built over the years. Together, these two concepts represent one of the clearest and most accessible paths to long-term financial security available to everyday people. You don't need to be wealthy to start. You don't need a financial advisor to open an account. You just need to start, and start as early as possible. That's a wrap on today's breakdown here at Capitalists versus Consumers. If this opened your eyes to something you didn't fully understand before, hit subscribe and turn on notifications. We drop new reports every week on how to build wealth, get out of debt, and take control of your financial future. We'll see you in the next one. Resources mentioned in this video: recommended book on investing, recommended book on retirement planning, recommended book on compound interest and wealth building. This video contains affiliate links. I may earn a small commission at no extra cost to you.